Hey, good afternoon. This is Trader Tim from EminiMind, and today we'll be talking about how to trade halfway backs in the afternoon trading session, along with Bitcoin and a couple other bigger picture items, including what to do as we approach the old sell in May and go away time frame, coming up on beginning of April, but our next Fed meeting is the beginning of May, and we could end up with a little bit larger sell-off as we head into the summer. And so we'll talk a little bit about why that is and what you can do to prepare. So first, let's go through today's day trades in ES, or two particular trades that I wanted to highlight, and then we'll talk about Bitcoin and some of the other bigger picture pieces. So if we start on the daily chart, you can see the 50% retracement long that I have drawn up on the ES is just from lows to highs. We broke the high to low 50% retracement, so the next step would be to draw the retracement in the opposite direction and see if we get a bounce around that 50%. At this point, but when we're sort of on our way down to a larger 50%, it's okay to take shorts. So like on the daily chart here, you can take a short even though we're waiting for a long to set up. Like you can ride shorts down into the long, and the same thing can be done intraday as well. So there's a couple daily halfway backs that have traded, and tomorrow, if let's say we bounced a little bit to the next 50%, that one could come into play. Or what's probably a little bit more likely is just we slide right into the 50% on the open. Tomorrow we've got CPI coming out before the bell, and then later in the week, Thursday jobless claims, and let's see, Friday industrial production. So pretty standard week as far as news goes, with the CPI kind of being that big one that everyone's talking about. That comes out tomorrow before the bell. So with that information, if we go to well, before we go to the intraday chart, look at the daily candles. Last week we had a couple of doji candles where the open was near the close, and today's breath, even though we had a trending day to the downside in the actual daily candle, intraday, as you'll see here in a minute, was actually pretty sideways most of the day. And the breadth reflected that with a around 1 to 1 breadth ratio, meaning the amount of volume going into stocks going up versus down was pretty balanced. So it made for limited intraday trades, except really the two that I'm gonna talk about here. And then last week we had a lot of the same with breadth ratios that were at 1 to 1. There weren't a lot of great opportunities intraday, and when you look at the daily chart, where we ended up was right where we opened. And when you're on a daily chart, it's important to put the emphasis on the close. I always like to put, when I'm doing swing trades or any type of trade that's based off of the daily chart, I like to do those, put those trades on, manage those trades at the close. So whether it's buying puts as a hedge for a long position, whether it's putting on a new swing trade position, um, assessing the closing candle is what's important. So, or the close of the candle is what's important. Now, if I determine that, okay, I want to get long above the high, let's say, of this low bar down here on the 14th, then I'm okay entering the trade when price crosses that candle's high the following day at any point. But when it comes to, managing and doing the assessment of what's the entry going to be, what's the am I going to trail my stop and manage the trade, waiting until the end of the day I find is much more beneficial in the long run, because you get in these situations where the market starts to move up and then every day makes a higher low, higher low, higher low, higher low. And if I just come in here and say, oh, we had a big move and I'm just going to exit intraday because we started to pull back, and I'm looking at like a 15-minute chart. Well, you can get faked out of a move or get out of the trade way too soon. So if you just stick to looking at the daily bars and just have some simple trail stop approach like dragging your stop underneath each candle's low every time the day closes, you're going to stay in those winning trades a lot longer than if you try to enter using the daily bars, but then turn to the intraday time frame and try to micromanage it and try to, pick the top intraday and get out. It's going to be much harder to stay in those winning trades. The other thing about the daily bars is that if you wait for a close of the candle to break the 61.8 as your failure, it's a more concrete price break. So like over here, the intraday, we broke the 61.8, but then we closed way down here. So rather than getting overly excited and having a little break of the 61.8 intraday and then getting out of the position, just wait for the close, and then you'll be able to be in a more objective state of mind. So let's go to the intraday chart now and talk about some day trades. The first one I want to talk about today was the first 15-minute breakout trade. And this one, we gapped down. We did not fill the gap in the first 15 minutes, so trade was a go. It did not trade right away. Like this first 15-minute candle formed, and then we moved sideways for like 45 minutes. And so it wasn't till about the 45-minute mark after the open that we broke the first 15-minute low. And if I go back, it was right here. So we broke below the first 15-minute bar. Sell stop 4437.75. Got into the trade. It kind of moved sideways a little bit, but didn't come back up, and it didn't really trade. There wasn't any heat on the trade. It went through the price and then just kind of moved sideways a little bit. 4-point stop goes out. Didn't come anywhere close to that. And then as we started drifting lower, by the time we got to this green candle, and then the next candle formed, was able to start bringing the stop down. When this, so 1, 2, 3, 4, 5, when the sixth candle formed, the high of the prior bar was the entry price, 4437.75. So I was able to move my stop to break even at that point. And then next candle formed, brought it down a little bit lower. Next one a little bit lower. We were down at 36, so only a couple of points locked in. Then the next candle formed, and that brought our stop down. Once it closed to, the stop was 4430 and a quarter. And so this one came out with like 7 points. So kind of slow, really not doing much else. If I go to a 5-minute chart, you can really see within that morning session, sideways, dead sideways off the open, just hovering right around that opening price. Then we got the move down, broke, got in the trade, and then sort of drifted down. It took a long time, but by and large, if you look at kind of this midday trade, late morning to midday, all sideways just underneath that first 30-minute low, which also happened to be the 15-minute low. So I think it was 7 and a quarter on that 15-minute break trade. No retracement trades in there. But then later in the day, for those that aren't able to trade the open or like to trade the open and the close, the halfway back of the day is going to be your best friend when it comes to trading at the close, because you have so much trade data that you could pull from for the last 6-7 hours of the day. And so if you just pull the full halfway back of the day, let's say we're like the last hour and change, hour and a half of the day, and that's when you're going to start trading. So we'll back it up like this. And so if you start by drawing the full halfway back of the day and see where that price level is, we can see that it's not too far off the low of the first 30-minute range. That high and low of the first 30-minute range will also be very, very beneficial. So those kind of 3 points, high and low of the first 30-minute range and the full halfway back of the day, use those as your starting point to take trades in the afternoon. And this afternoon, we ended up coming right to that halfway back of the day. Let me get to that on the 512. And that was over here. And so now we can see a lot of the trend that was occurring throughout the day. And by and large, we were down, sideways to down. Certainly, we were lower than we were at the open, at the simplest level. Where are we in relation to the opening price? Well, we were slightly lower. Okay, so we moved down throughout the day. Great. Halfway back short, 30-minute range. This is the bottom of the 30-minute range right here, 4438. And just looking to the 512 tick chart, once you break a swing low, which was here, to take a short. And then entering on the 512 tick chart. So kind of doing the analysis on the 5-minute or the 15-minute, doesn't matter, and then coming to the 512 to place your order. So 443275, just rounding down so that you can get a fill if it, in this case, stops right at the 50%, and every once in a while it does to the tick, stops at the 50. So that's why you want to put your order one tick in front of the 50 because price needs to go through your order in order to get filled. And then from there, just trailing swing highs on the way down. You can draw the next retracement and trail the 61.8 to give yourself a little bit more cushion. But I find that once we're away from the entry price and break the swing low, once you get past, say, the second retracement in the series, so this would be the first one that we entered off of, and then the second one trades away from its 50%, now you can start just coming in here and trailing swing highs. Trail the swing high here, you get a nice strong move down, trail the swing high. This is kind of a double top, so you don't really get an opportunity to move your stop down on this leg. Then you trail it down here, moves lower again, and then boom. Over here is where it breaks the high of the swing, or the swing high, if you will, right here, gets taken out on this push up. So you don't want to be in trades too close to the close, just because you can get stuck in a trade overnight, which you don't want to do. So getting flat 15 minutes before the bell, if you're really disciplined, 5 minutes before the bell. But it doesn't take too many trades in the afternoon. If you're coming into the halfway back of the day like this, and you can take one trade, I mean that went from 44.33 all the way down to like a 44.13. I mean, that was a big move, and it's just one trade, and you're just trailing your stop the rest of the way down. So that's a good way to trade the close. You don't want to go too crazy, especially because you don't have that much time, and you start taking a whole bunch of trades and stressing yourself out, and then the market closes, and you're just all pissed off because you made some bad trades or just got too excited, and you're saying to yourself, oh, I should have just quit after the morning session. So, but if you can only trade the close, same thing. It's okay to just make one or two trades and then call it a day. Last thing I want to touch on here is Bitcoin. Let's go to the daily chart. I did do a buy here at 40K, or an add, I guess, to the position. I would have preferred if this hammer here, so here's the daily chart. I'll back it up a little bit. Daily chart, we have this big ascending triangle. We broke out. I bought back here kind of at the uptrend line, and that's why I like 40K as 40,000 as an add. It would have been nice if this hammer could have pushed us a little bit higher. It didn't. We rolled over. Same with here, a little bit of a fake out, and we rolled over. But now that we're back at the uptrend line, I see this as a nice opportunity to add. There's been enough of a pullback to where the risk is much lower than certainly than buying up at 48. So I did a little add to at 40, and I'm looking for us to move up to like the 51,000 area if we can get a push off this. The failure point I'd be using is back here, this swing low. Up until this point, all of these lows along this uptrend have been higher low, higher low, higher low. You get the picture, moving higher along this uptrend line. So that's what I'm doing with Bitcoin. And the last thing I wanted to touch on, I suppose, I lied, was the VIX, and really struggling to get back up above this trend line here. We're up in the mid 30s, which isn't crazy high, but it was certainly higher than we are at now. And so if the market if the S&P continues its pullback and we go through the 50%, more importantly, if we close below the 61.8, then I really want to see the VIX close back up in ideally in the mid 30s. Like there needs to be some significant push up and close above the trend line, and that's taken us into at least 30. If we just come up here, knock our head, and then volatility kind of falls back down, and you're seeing the S&P just kind of chopping around, moving sideways, and we get through some of these CPI jobless claims, some of these other numbers that are being talked about as they might be a little bit more scary this time around this month. If we can get through that and just move sideways, then that's actually pretty bullish. We've got some support back here from prior trading, and we have the 50% below us that, yes, if we come down to it, it would just be considered a double bottom, and that could get us a push higher. But by and large, sideways movement at the 50% is only building a stronger base. So at this point, I'm fine with looking for some swing trade longs here at the 50 and see if that pushes us higher. The next Fed meeting is the beginning of May, and the old adage, sell in May and go away, could be one that takes effect this summer. Maybe not for the fact that we have a big sell-off, but just that there's not as much volatility if we can't, just as we looked at that VIX chart, if we can't get back up into the upper 20s, mid 30s. If we stay down here in the low 20s, it could be a quiet summer of just kind of sell in May and go away as far as not being super active with your trading. But I will definitely be putting on some puts going into that next Fed meeting announcement beginning of May. So keep that on your calendar. And when we get a week or two out, especially if things are just kind of moving sideways, I would be interested in putting on a hedge just in case, because if the Fed raises interest rates more than 0.5% and starts to freak some people out with being able to risk or to borrow if you're a big tech startup or tech firm, that's going to be one of the bigger risks that'll come into play to the stock market. But then housing market and mortgage rates and things like that, there's still a lot of unknowns with how the market's going to react with rising interest rates. 1/4 point hike is extremely small and uneventful if you're talking, raising 0.5% at the next 4 or 5 meetings. So keep that Fed meeting May 3rd and 4th on your radar. Don't want to get caught with, an opportunity to make money when the market potentially goes to the downside. Just because you might forget about it. So if you have questions, drop them in the comments below. If you like these videos, go ahead and give them a thumbs up, and I will talk to you all soon.